Hey there, folks, and welcome to the Kevin Strong Show. And in this video, we're going to talk about the Jerome Powell killed the Trump rally, how that possibly is going to affect the economy moving into 2025. I'm going to talk about that. I'm going to also talk about an ominous comparison between what's happening with the Fed moves now and compare that to 2008. And we're going to also talk about why I think the dollar is going to remain the world's reserve currency for the foreseeable future. So if you're new to the show, welcome. Think about subscribing. If you do enjoy this content, at the end of the video, show me some appreciation by hitting the like button and consider leaving a comment. So without further ado, we're going to slide over here and talk about this situation. So first of all, for those of you who didn't follow this, the Fed cut by 0.25 basis points, but the comments that were made by Fed Chair Jerome Powell were very, very, very ominous to the stock market. And as a result, the stock market lost over 1,000 points on December 19th. It is somewhat rebounding on December 20th, the next day. I'm getting a little bit confused because I'm actually filming this while the market is live. So it went down 1,100 points on 12/19 and is rebounding, a nice little rebound, starting to basically establish some support the next day on Friday, which is December 20th. So what is this graph about here? This is the Fed's funds rate. And as you can see here, following my mouse, in 2006 leading up to the great financial crisis, the Fed funds rate was at about 5.25%, and then it dropped precipitously as a result of the great financial crisis. As you follow my mouse down here, and there's this baseline here, this goes all the way up to around 2012. It doesn't really show it clearly on this graph, but this is when I was saying that even though the Fed had cut rates down to almost zero in 2008 during the great financial crisis, home prices were still suppressed. They were still going down, and housing activity was basically stalled out, and it didn't start to rebound until 2012. This is the argument by saying that the Fed can't save the housing market if, which is a big word, we have a significant pullback in housing in aggregate. Once again, I'm talking about in aggregate. I know there's exceptions in each and individual housing market is separate. So what is also ominous about this is, so you can see here, moving over to the right, in 2024, we're pretty much at the same level and leveling off as we were during the great financial crisis. But what's also ominous about this, not only is this pretty much at the same level, in 2008, and I think either on September 17th or September 18th, the Fed cut by 50 basis points. September 17th of 2024, they cut by 50 basis points, and then they cut two more times. So we're following the same pattern now as far as Fed cutting rates as we did in 2008. Very ominous, very, very ominous. The dollar, for those of you who follow macroeconomics, the symbol is DXY. The dollar has recently been gaining strength. This is also putting pressure on foreign currencies. As a result, everybody else around the United States is having severe financial problems. They're cutting rates at a much faster pace than the US. So one would surmise that it could possibly be only a matter of time before the US catches up with the global market. For example, Brazil is in severe contraction. Japan, I think Germany cut by 2%. China's imploding. France is imploding. India's having problems. Canada is also having problems. So this could only be a matter of time before this hits the US. This is going to be very interesting. This is why I said, folks, in my last video, I think there's a lot of things that Trump wants to do that's very, very efficient. You know, it's probably overall going to be good for the economy, but don't be surprised if it takes time. This is not going to happen as quickly as people think. As they say, don't be surprised if your temperature starts to rise. So don't get pissed off, because it could take some time, or there could be the potential that as he transitions into taking over executive leadership of this country, he could be the captain of a Titanic. There's some underlining financial components that are brewing, that are percolating to the point where even he may not be able to solve some of them. But I digress. Moving down, let's talk a little bit more about this article. This basically saying Powell's new stance was a departure from comments just 2 weeks ago when Powell offered assurance that the overall outlook had not changed much despite some hotter than expected readings at the start of the year. So during his Q&A, he basically said that he only thinks that we might only be looking at 2 rate cuts in 2025. The market did not like that as well. I'm going to go back up to this chart and tell you why I think that's BS. If we're heading into a recession, and I think the Fed is going to be behind on this, just like they were during the great financial crisis, which is going to happen is that they're going to have to start cutting rates at a much faster rate to try to cool this thing off. It's just not going to happen. Historically speaking, could this be different? Possibly. But I think by the latter half of 2025, starting in June, the Fed's going to be cutting a lot more. They're going to cut a lot more than 2 rates in 2025. And my humble opinion, it says, we have seen at the FOMC that we will need greater confidence that inflation is moving substantially towards 2% before it will be appropriate to ease policy. Inflation fears are rising on Wall Street. Markets were thrown for a tailspin last week following hotter than expected data for the 3rd month in a row. CPI rose 3.5% over the prior year in March, an acceleration from 3.2%. This is why some of the people subscribe to the point where they think potentially you're hearing some narratives talk about stagflation. And you might hear more stories about stagflation the first quarter of 2025. For those of you who don't follow that, that's basically in a nutshell. We've got high unemployment, which I think we are going to be moving into, and high interest. I shouldn't say high interest, inflation. Sorry, inflation. So inflation is moving up, and so is unemployment. You know, that might be a recipe for stagflation. That narrative might become a little bit more prominent in the first quarter of 2025. But once again, in my opinion, based on that Fed fund historical pattern, I think by the latter half, it's going to be cooked in. They're going to know they're in a recession, and they're going to be trying to aggressively bring rates down to reignite the economy. But I think because of the global situation with all those countries that I mentioned before, Brazil, Japan, Germany, China, France, Canada, India, the impending commercial real estate market that's about to implode. I think all of these factors are going to make it very, very difficult for us to respond in a positive way to rates that are reduced by the Fed. So my final point that I want to leave you guys with, guys, is why I think, calm down. Don't listen to all of these so-called economic mavens that are telling you that the dollar is no longer going to be the U.S. Reserve's currency, global currency. I just don't subscribe to that. You can do your own research, but it's my understanding that there is more debt that has to be paid outside of the U.S. than inside of the U.S. That debt has to be paid back in dollar denomination. Okay, once again, there's more existing U.S. debt outside of the U.S. than inside of the U.S. So for the dollar to use its global, for it to lose its global reserve currency status, what in theory would have to happen? First of all of that debt would have to be paid back in dollars. Okay, and that's going to strengthen the dollar. And then these foreign companies, in order to pay this debt down, are going to have to probably create more of their own currency to pay back in dollars. That's going to devalue their own currency. So it's like a vicious doom loop. It's almost like being in a canoe in a lake and you have a small hole and you're constantly trying to bail out that water saying, yep, I'm going to get this water out of this canoe. And the water represents the US dollar or the US dollar as the global reserve currency. But you're in a lake. So theoretically, is it possible? Is it going to happen in our lifetime? Highly unlikely. Highly unlikely. If I had to give a probability to that, I'd probably say in the next 40 years, probably under 10%. So once again, those dollars have to be paid back in U.S. debt. So that basically makes it virtually impossible. Obviously, Fed Chair Powell and President-elect Trump don't see eye to eye. I think, like I said, you guys need to manage your expectations. I think there's a lot of things that are coming up in 2025 financially that regardless who would have won the election, they're going to have a hell of a time trying to prevent that Titanic from sinking. So you're going to have to be patient. And it's going to be very interesting because the Obama administration, Obama said, hey, I handed Trump a good economy. And Trump took credit for it. Whether that's true or not, I don't know. That was the political narrative. I'm not saying how I feel about that. Biden probably can make a cogent argument if things start to fall apart by the second half of 2025. He may be able to say his political narrative from his team could possibly be, hey, I hand you over an all-time high stock market when you took over in January of 2025. Look what you've done now. That's almost saying, hey, we're headed towards these icebergs. Now all of a sudden, I'm going to anoint you as the captain of the Titanic. So be careful and be patient. Once again, do not let politics pollute your prosperity. Regardless who's in office, regardless who you voted for, you owe it to yourself and your family always to do your very best. And if that requires you to restructure or re-examine or revise a new plan because the plan that you had set up was based on something else, you still have to keep moving. So at the end of the day, keep your credit score up and your debt down. I hope you enjoyed this edition of the Kevin Strong Show. If you have not subscribed, please consider doing so at this point in time. And if you enjoyed this particular episode of the Kevin Strong Show, do me the honor, show me some appreciation by hitting the like button, and please leave a comment if you agree or disagree with any of the general points that I made in this video. Have a great, great weekend, ladies and gents. Oh, by the way, God, I almost forgot about this. Really, really, really thank you. I want to thank all of you guys, all my subscribers. I was at like 371 for the longest. And within a 3-week time period, my subscriber base has gone up 40%. We're at like over 500. So that's a really, really big milestone, you know. So let's see if we can get this up to 1,000. So things are going well. I've gained 140 subscribers in the last 3 weeks. So obviously the message is getting out there. People are commenting more. So I do appreciate the feedback from those who agree and disagree. Thanks for watching. I'll see you in the next one. Make it a great day.